Hello traders, in today's video I'm going to be talking about what influences price and what really should we be focusing on when trading and investing. Okay, so let's start. I've categorized three different types of factors, or really things that cause price to change. There are direct factors, incentivized factors, and indirect factors. It'll all make sense when I show you guys the upcoming slides, but essentially what I've done in this presentation is each factor has a subset of factors that are listed by importance. So within direct factors, here's what we have. The most important thing for you to focus on and what directly impacts price are regular market orders. This is really the bread and butter of any system or any instrument out there, whether it's crypto, commodities, or equities. Regular market orders are something you have to know and really you have to master. And if you want to get better at really learning how to do that, you can use Bookmap. I have courses on it. I have plenty of videos on it too. What else impacts price? Well, another direct impactor on change of price is actually the best bid and best offer. In markets that aren't that liquid, so altcoins that maybe only trade a few $1 million a day, what can happen is the price might change a fair amount, but no market orders were ever hit. What ends up happening sometimes is there might be a very large bid and a small offer, and then the offer moves higher, then the bid moves higher, and then let's say the bid is still quite large at the best bid, meaning the top bid, and the best offer, meaning the lowest offer, is still quite low. Then they keep moving up, and no market orders even took place. That happens all the time. So that is another direct factor of change of price. It's something you really do have to focus on too. Now for the other three factors, these are far more advanced. If you want to take anything really away from this presentation, the most important thing that you should be focusing on if you're a short-term or medium-term minded trader is you got to master market orders and looking at the best bid and best offer and interpreting that. Now let's go over to the more advanced stuff and potentially less important, but still it can give you some edge. Stop market orders. Another direct impact on price is where there are stop market orders. An example of that is the stop loss. So a common thing is traders do like to put their stop losses right below support when they're long, or what they also like to do is put them right below round numbers. So an example of that would be what actually recently just happened. Bitcoin was at $40,000 and it went a little bit below 40,000, and then just like, a light or two gasoline, it just tanked $400 down to 39,600. Happens all the time. That's because of people's stop losses and liquidation levels, but more importantly, stop losses. Iceberg hidden liquidity is a little too advanced for this video. I want to keep this short. But that's basically hidden limit orders. You don't really have to focus on them too much unless you're really short-term minded. Yeah, I would say even potentially more important is bot triggers. This is the most advanced thing you're going to hear about in the entire video. Bot triggers are something very difficult to master. I think it would take someone with really good pattern recognition, or at least a few years to really master that. What bot triggers are, and this is another direct impact on price, is when we take certain actions or other people take certain actions, certain bots are going to execute certain orders. A pretty good example of that is the classic order depth imbalance. What that means is imagine that there's a limit sell order known as the offer, and suddenly a best offer that is $1 million comes out and it's just listed right here as the lowest sell. And the best bid and the bids below that, let's say they only total $20,000. So we know that the offer is 50 times bigger than all the bids in the within 1% of price, okay? If that happens, there are bots that are out there that will probably begin to either front run that large limit sell order or will begin to market sell and try to take some of that liquidity that's left. Those are known as bot triggers. Basically, when actions are taken in the market, and then certain bots immediately kick into action to do what they are programmed to do. Those are the direct factors on price. But again, you just really need to master best bid, best offer, and regular market orders. This is my favorite part of the entire video, probably. Incentive factors. We have direct, incentive, and indirect. Incentive factors are things that don't directly impact price. They're not guaranteed to impact price, but there's a large incentive for traders to trade a certain way. What do I mean by that? Let's look at arbitrage. Imagine that the FTX rate for Bitcoin was $400 less than the Coinbase rate and the Binance rate. So it's a $400 premium. It's a lot cheaper. There is a very high incentive for traders to buy and a very small incentive for traders to sell. Why? Well, if you buy, you're buying $400 less than where you could buy elsewhere. Duh. Why is there not really much of an incentive to sell? Well, if you sell, you're selling $400 below the fair value rate. Why would you want to do that? So because of that, that's not a direct impact on price. It doesn't hit it in the moment, but there's such a strong incentive that it does impact price very likely. And that's why I listed it as most important. And again, it's most important going down. Order depth changes. Now guys, what I mean by this, because I know I just did talk about best bid, best offer as a direct impact of price, which it is. But let's talk about order depth changes that aren't at the highest buy price or the lowest sell price, i.e. not the best bid, not the best offer. Order depth changes have a fair amount of incentive factors. And in the next slide, I've actually prepared a whole thing about that. So we're going to be talking about that soon. But let's go on and then we'll talk about order depth. Concentration of open interest. Again, this is going to get a little bit more advanced, not as advanced as like bot triggers, but another incentive factor that you do have to think about is imagine there's an altcoin. And let's say 50% of open interest is held by one person. One bot, one whale, one trader, the exchange, you name it. This is something that changes the game a lot. Because one of two things typically are going to be happening. A large whale buys and now holds 50% of open interest. After that large whale buys, he's now looking to sell. In that case, it would probably be better for us. It's incentivizing other traders who know about this to sell, right? Because we want to sell before that big whale sells. That's how we make money. However, it's not that easy because guess what can also happen? It happens very often. Even though it's not always the most ethical, a large whale might buy with 50% of open interest held in a long position, and then he might spoof the market higher, meaning that he's going to put a lot of large bids, he's going to be stacking them in the order depth. Maybe he's going to be picking off small offers by little market orders. So he's going to keep putting on bids, market orders, attacking the offers, and pushing price higher. In that case, selling is actually probably a pretty bad idea. When that happens, people are typically more incentivized to buy. So this is what I mean by the incentive factor of a large concentration of open interest being held by one person or a few people. The incentive is basically if that whale wants to sell, everyone in the market is basically incentivized to sell, right? And if that whale wants to push the market higher so that he can sell at a higher price, then basically everyone in the market is incentivized to buy because it would be pretty idiotic to try to sell into a massive whale who's just going to blow you up and just push the market higher. That's something that you do need to focus on, but it is a bit complex and it might take some time to really understand that. But I do have a course on that you can check out. Funding rate. This one's great too. So when the funding rate is positive, what that means, guys, is that the futures market, the perpetual market, is trading above the spot price or the spot index. Essentially, that means that traders are typically incentivized to short. Two reasons why you're incentivized to short when the funding rate is positive. The first reason is if you short and the funding rate's positive, you will earn the funding every hour or every 8 hours, depending on the exchange, right? So you're incentivized to short when the funding rate's positive because you're going to earn money every now and then. Another reason why you're incentivized to short when the funding rate's very positive and the perpetual price is much higher than the spot price is because you're getting a better price, essentially. You know, if we were to look at all the different prices we could get relative to spot, that would be a pretty good one. Especially if the perpetual rate's way above spot, then it's a pretty good price relative to spot to actually short. Vice versa for a negative funding rate. When the funding rate's quite negative, what tends to happen, well, what it means is that the spot index is trading above futures, meaning that the futures market is cheaper than the spot market. People are incentivized to buy to earn that funding rate, and they're also incentivized to buy to pick up a lower futures price than what is typically normal. Those are incentive factors you do need to know before we enter into a position. For example, if the funding rate just turned from negative to positive, and now the price is beginning to, let's say, fall a bit, it's going to be a little scary to long. Because if we do long that positive funding rate as price is falling, people are incentivized to sell because they're going to earn funding and they're selling at a better price relative to spot. So it's going to be a little scary for us to long. I mean, you know, you could, but the incentive really isn't in your favor. Another incentive factor is just the lending rate. This one's super simple. Imagine that the lending rate of BTC. Let's do a better one. Let's say the lending rate of KNC, an altcoin that I don't really care about, but whatever. Let's say that the lending rate of KNC on FTX goes from 10% APR, meaning you can lend KNC and earn 10% a year. It goes from 10% to 2,000%. If that happens, it's incredibly, incredibly likely that the price is going to skyrocket. Why? Well, I'll give you guys a few seconds to kind of figure out why the price is probably going to skyrocket initially when that lending rate hits like 2,000, and then I'll tell you the answer. When the lending rate's quite high, the incentive factor to buy is much greater than the incentive factor to sell, because we can buy and then lend it for 2,000% a year. On paper, it looks great. The incentive factor to sell really isn't worth it because of two reasons. If we own KNC, why would we want to sell if the lending rate skyrockets? People are going to buy it anyway. And instead of selling, we could just lend it. So that's why the incentive factor to lend is something you also need to focus on, but it's not as important as the funding rate. Last one I don't want to talk about because it's not as important, but airdrop and rewards can also be a factor. If there's an upcoming airdrop of something, and if you hold a token on a certain date, then a lot of people want to buy that token, to get the airdrop. Duh. So yeah. Order depth changes. Here's what tends to happen. And this is a simplification, but I provide a lot more in depth with a course of mine if you're interested in that. When a large bid is added, what are the incentive factors that occur? Well, when a large bid is added, let's say it's 100 times the normal 1% order depth, right? So it's basically just a massive limit buy order. Offers are incentivized to cancel. Why would you want to cancel your limit sell? Well, if a person wants to really, really buy, can't you just set your offer a little bit higher? That's what a lot of people are incentivized to do. They're incentivized to put their offers higher to fetch a better price. Or they're scared of that large limit buy order just running them over. Bids front run. This is when bids are going to be placed in front of that large buy. Why do people do that? Well, they do that because of the natural support level that a large bid has if the bid stays. An example of that is, imagine that there's a $10 million buy order on a coin that normally trades a few $100,000 a day. That imbalance is absolutely insane. And if that buy stays, a lot of people are going to be incentivized to put buy orders right in front of him, because guess what can happen? If you get filled on that buy, you have all of this, upside potential, and if it ever gets scary, you could just sell on the large buy wall with like a 0.1% loss. So because of that your risk is so low if the bid stays. Your risk is so low of like 0.1% after fees because you front run him, and the reward is massive because price could skyrocket. People want to front run large bids. Makes sense. Finally, why do market buys hit? When a large bid is added in the order depth, people do tend to market buy because they want to grab the liquidity that they can before price inevitably goes higher. Because if a guy puts a bid here, then here, then here, then here is climbing up the order book, market buys will probably begin to hit because that guy looks like he's about to buy up the entire order book. You want to buy before he does. Got it. Completely opposite with large offer added. Imagine there's a massive limit sell that's added. What are the incentive factors here? Bids are typically going to cancel because why buy now when we could buy lower? If a guy massively wants to sell, I'll back off and put my bids lower. Again, offers front run because of the same reason. If there's a large sell here and we sell here, our risk really isn't that much. Market sells are probably going to hit because if a guy really, really wants to sell and is putting that offer lower and lower and lower, that can cause some fear and panic, which can cause people to just sell, sell, sell. Okay, so that's when a large order is added just like out of nowhere, and then it moves aggressively with price. An aggressive limit order move, guys, is when a large bid is added here, and then it climbs up like that. The buy order is getting higher and higher and higher. That's aggression. A large offer, being aggressive, would be when an offer goes from here to here to here to here and is just lowering with price. That's quite aggressive. Now let's talk about more passive orders called static bids and static offers. What are the incentive factors here when we see a static bid? Well, if price approaches a static bid, what a static bid, guys, is a bid that's been unchanged for a very long period of time. Imagine that there has been a $10 million bid, but it's been in the market for 5 days. And people have sold on it before. That bid's probably not as strong. because it's already built into price. It's already built into really the supply and demand that you're looking at on the market. What tends to happen is if price approaches that large bid and market sells begin to hit, that's typically very, very bearish. It's bearish and people are incentivized to sell because typically what happens when a static bid gets attacked by market sells is that when it falls, the price just tanks because there's probably not a lot of liquidity below that bid and price falls apart. That's typically quite bearish. And then, of course, large static offer that's been there for a while, market buys hit. Not many offers would probably be above a large static offer, so it's typically quite bullish. All right, so those are the incentive factors that you need to focus on with arbitrage, with order depth. I've been showing you a lot of that. With the funding rate, these are all incentives to focus on. Let's talk about indirect. This is where we might, some people might argue that some of these aren't indirect or are, but I do believe that these are not direct factors. They don't directly impact price. And they're not incentive factors. They're just indirect factors that indicate what might happen in the future. Okay. Sentiment and crowd expectation is an indirect factor, but it is probably the best one here. I would say that in blockchain data. Basically, sentiment crowd expectation, yeah, does it incentivize price? Kind of, but it's muddy. It's muddy. Typically, we want to buy when people are fearful, sell when people are greedy, yada, yada. You've heard that a million times. But it doesn't directly impact price in the short term or the medium term. It's more something that indirectly can inform price. Okay, my hair is like insane right now. It's terrible. Oh my God. Okay. Blockchain transfers. That's another one. A pretty good example of how people would use blockchain transfers in market forecasting is imagine that we have an altcoin that's, market cap of 100 million. And out of nowhere, a $25 million worth of that altcoin is sent to an exchange. That's pretty bearish and pretty scary. Because if a dormant wallet is sending 25 mil or 1/4 of the entire market cap to one exchange, he might want to sell or convert it to a different token, which is probably going to lower the price. That is not a direct factor or an incentive factor, but it is indirectly going to impact price. Price action volume, yeah, the past, basically. RSI, MACD, MA, these are all indirect factors. These indicators, what a lot of retail traders don't understand is they don't directly impact price and they don't incentivize price. Really, there's no direct incentive to buy if RSI is low, besides the fact in your head that you might think that other people might be buying because RSI is low. But besides that, there's no direct incentive for people to buy when RSI is low on your 5-minute time frame or whatever. Other indicators that do not read past or present supply demand are also called indirect factors. If you want to study blockchain transfers and sentiment crowd expectations, I highly, highly recommend sentiment.com. Such a good site. You got to check it out. And then the other ones you can find anywhere. Technical indicators you can find anywhere. Price action volume you can find even more places. So let's put it all together. How do we forecast price? I've been telling you all this. First thing you got to do is you have to determine how long are you going to hold this trade or investment. If you're looking for short term, then direct factors are very, very, very important. Incentive factors are almost as important. Why? Well, in the short term, we need to look at market orders. We need to look at best bids, best offers, order depth, arbitrage potential that could impact price, funding rate, lending rate. You need to look at those things because if you don't, you're going to be misinformed and not using the information that you should be using at your disposal. However, if we're talking long-term price forecasting, months, years, with investments, then incentive and indirect factors are a lot more important. It's not really that important in the long term if the best bid or best offer is 10x, the order depth of 1%, or if a $50 million market buy hits. In the long term, that really does not matter at all. On Bitcoin, at least, it wouldn't matter at all because it's 50 million that's like a drop of water in a pond, over like 2 years. Yeah. But incentive factors are also important. Incentive factors are important in the short term and in the long term. How are incentive factors important in the long term? Well, if the funding rate is very, 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 very positive, meaning that futures traders believe that the market will rise, traders are typically incentivized to short, which could lead to a gradual decrease in price. That's one example. When you're focusing on direct factors and on incentive, you need to focus on the market reaction to certain events. Always focus on the market reaction to large bid offer walls. That's an easy one, and large market orders. Do you notice that if a large market buy hits, what tends to happen to the coin you're looking at? Does it tend to go up because the market buy hits and then kind of trickle down a little bit because there's not enough demand to push it higher? Or does that market buy tend to just erupt demand much higher? You need to be able to uncover the difference between those two. If you're an advanced trader, one of the best things you can do if you're at that level is to ping bot triggers. Pinging bot triggers is testing out different actions to see if you can uncover what other traders are going to do based on the code that they have, the code they have in their bots. This is something I would not recommend for a beginner because you're just going to get confused. Even for an intermediate trader, this might be a little bit above your pay grade. But if you're at that level where you really want to get perfect fills and really want to trade at the highest level, attempt to uncover bot triggers, find where people's stop losses are, find where people's liquidations might be, do all of that extra work to try to see where the market might be pressured toward. Finally, try to learn and eventually master each of these factors at a time. They're all important. Even indirect factors can be very important in medium to long-term price forecasting. But to start, I would highly recommend taking a deep dive into order depth, market orders, and the funding rate. If you can do those three, then you're going to be pretty good. And then also probably add open interest, because one intermediate to more advanced thing you can do is try to look for when a large whale enters into any coin. A really good example of if you want to find how is a large trader entering, they typically do the same pattern. You go to open interest chart and then also pull up a volume chart or a buy-sell volume chart. On Coinalyze, they offer that. Look for when open interest skyrockets, meaning that a large person just added, large trade just occurred and someone just opened a large position. If it shows you that there's a lot of net buying like that, typically what that means is that a large long just entered. If there's a lot of selling and price tanks, typically that means that a large trader just entered into a short. Diagnose what traders are doing and what the largest trader is. Is it a large long? Is it a large short? And then after they enter, if you feel like you're up for the challenge, try to look around to see what they're trying to do to influence price. If they're not doing anything, either they're long-term minded or they might be trying to exit their position soon. If they're trying to influence price higher because they bought, then be careful selling. With that, there is so much more I could talk about, but I think I've given you guys enough material to go study on your own and to really learn these things. And if you want to become an elite trader, focus on these things. And if you want even more practice, I'm going to give you guys some courses down below that can help you in different points. With that, happy trading, and I'll see you in the next one.